Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Fibonacci retracement levels, a powerful tool that can help you identify potential reversal points in the market with precision. This is basically what the Fibonacci retracement tool helps us to understand. Whether you are struggling to pinpoint entries and exit levels or looking for a way to improve your risk management, this strategy could be the missing piece in your trading arsenal. So stay tuned until the end of this video as I will walk you through everything you need to know step by step so that you can start using the Fibonacci retracement confidently in your trading strategy. Now we start by understanding what the Fibonacci retracements are. And the Fibonacci retracement is a widely used technical tool that helps traders to identify potential reversal points, either potential support or resistance points. These levels are formed during market pullbacks or correction. This is based on the Fibonacci sequence, a mathematical formula where each level is summed up to preceding numbers. The key levels for the Fibonacci retracement are the 23.6 level, the 38.2 level, 50% level, 61.8 level, and the 78.6 level. These are the levels that we should be paying close attention to, and they are deriving from ratios within the sequence and are applied to price movement. This level acts as markers on the chart indicating areas where price might pause or reverse from or continue its trend. For example, in an uptrend, you would draw they will act as support areas when pulling back. Conversely, in a downtrend, they act as potential resistance zones where price may stall before continuing in the down direction. Like this, if we are drawing this in a downtrend, at this area we can see how these Fibonacci levels act as potential zones where we expect price to react from. This is basically what it means. This tool is particularly effective in trending markets where traders use it to measure how far price has retraced to or from in its previous move. By combining Fibonacci retracement with other technical indicators like candlestick pattern or momentum oscillators, traders can gain deep insight into the market's behavior and make more informed decisions. So this is basically how we spot these levels on the chart. If you can also project this in this area, we will see that this retracement tools plot line areas where price potentially may reverse from. These are areas we are talking about, and so on and so forth. So let's see the trading strategy that we can apply using the Fibonacci retracement, a step-by-step guide. First of all, you identify the overall trend of the market, and we can see the market is trending to the downside, making a series of lows, a lower low, a lower high, a lower low, a lower high. This is basically signifying that the market is trending to the downside. This is a typical example of what we are trying to talk about, where market is breaking structures as it goes or moves to the downside. This is when market is breaking structures as it's moving to the downside. Before using your Fibonacci retracement, it is essential to always determine the overall trend in the market. Trends can be bullish, that's to the upside, or bearish to the downside. In a bullish trend, price makes higher highs and higher lows. In a downtrend, price makes lower lows and lower highs, lower lows and lower highs. So in a downtrend, you need to draw it from your swing high to your swing low. This is typically how you select the most visible swing high to draw your Fibonacci tool from the swing high to the most noticeable swing low on the chart. This is the most noticeable swing low that broke the structure. This is where you draw this on your chart. This is how you place your Fibonacci tool on your chart. And this Fibonacci tool automatically plots the Fibonacci levels on the chart. As we can see, it has plotted our 50% level, 61.8 level, and our 78.60 level. These levels act as potential zones where price may reverse or consolidate. We should always focus on the 38.20 level, the 50% level, and the 61.8% level. These are considered stronger areas for price reaction. Do not forget, you wait for price action at these key levels, and as we can see, when price got to this key level, this 61.8 level, I hope you can see this. I will extend this two out so that it will be more visible. When price got to this 61.8 level, we can see the reaction from the price at this level. First of all, there was a pause. You can see that market was weakening, was pausing at this area. You can also look for consolidation. In some cases, you can also look for reversal candlestick patterns such as this bearish engulfing. These are the patterns you can look for at these key levels. You can also use your momentum candle, your momentum indicators, right, like your RSI or your MACD. Beginners should always wait for confirmation signals before entering a trade. You should always wait for a confirmation signal before you enter a trade at this level. So as we can see an indecision candle followed by a bearish engulfing. This further strengthens our bias that the market is trending, is going to continue the prevailing trend. So we enter at this key level. In a downtrend, you enter a short position at the resistance level. So when we notice the price is going back, it's pulling down, has reacted from this area, we can set our entry to this area on the chart. We set it in this area, enter our short position at the resistance level. If you want to be more conservative, you will go to your lower time frame to spot an engulfing pattern at this area. This is going to help you to combine other strategy, other multi-time frame analysis into your setup. Now going to the 4-hour time frame to look at that area, and as we can see, price gave us a bearish engulfing pattern in that area. This is where we would want to enter our trade. Remember, we analyzed from the higher time frame before coming to this area. We place our short position at the entry at the close of the engulfing. Then you put your stop loss above the previous level. You put your stop loss above the previous level. When I go back to the daily time frame, the previous level where the move started from, above this 61.8 level, this is where your stop loss should be placed, above this level. Then your take profit, you can use your Fibonacci extension to grant yourself areas where to plot in charts that can be potential take profit area. If you don't understand how to use the Fibonacci extension tool, you can check out our other videos on how to use the Fibonacci extension tool. You can also make use of a fixed take profit of a fixed risk to reward ratio of 1:2 or 1:3 as the case may be. This would further help you to target zones or project your take profit to areas you expect price to get to. You can also combine with other indicators. The Fibonacci retracement works best when combined with other tools. You can combine with the moving average. This is to confirm your overall trend. Where you put your moving average, it will confirm your overall trend, and when price is trading below the moving average, signals that price is in a downtrend. So this is how you can combine with other indicators. You can also combine with the MACD or the RSI to validate momentum shifts near the Fibonacci levels. Then we can finally use our candlestick pattern like we used an engulfing in this area to enter our trading setup. You can look for engulfing or hammer patterns at the retracement zone. This combination provides strong signals and reduce false entries. Always always enter a trade from this level when you find out that you have a confirmation. Now let's use our RSI to further understand how we can get this pattern. And as we can see in this area, when price is trading below the 50% region, it means that we are trending to the downside, and price was coming from an oversold region. an overbought region. So this signals that price is going to trend to the downside. When price is constantly trending below the 50% region, signals that we are in a downtrend. Alright traders, we have come to the end of this video. Please engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.